I'll ask Graham to turn on his mic and screen here. And while we just get started, hey Graham, good to see you. We're gonna
Hey,
pull up the first poll, not the first poll, but the first poll in a while. And so everyone, please fill this out. It should appear on your screen momentarily. And in the interim, while people are answering that poll, I would also just remind everyone. Uh, During this next session with Graham, feel free to put questions in the Q&A. We're going to try to get to them at the end. You can put general questions in as well, and we're going to be answering them as we go. So this poll question out there, which blockchain asset class investment strategies am I most interested in learning more about? So you just heard some that I would classify as mid-stage. Those are both kind of mid-stage, getting to late stage, hopefully. Companies, those are both companies that were in our fund of funds at the early stage. So they're backed by top blockchain investors at the early stage. We invested in both in our mid-stage fund, once they got to a certain size and scale. And it's actually the same story here. So I'll put the poll down. Thanks for filling that out. With Graham Rodford, another one of our mid-stage holdings, and an absolutely fantastic company building in the heart of tokenization. Graham is, I think he's in New York today, but he's based in London. Another EMEA company. We're catching just the very last afternoon of our European investors. So Graham is really building at the heart of one of the most exciting areas in the space, which I touched on in the keynote and it's kind of come up, but that is tokenization and really, bringing financial products on chain and really sitting at the nexus of institutional firms and institutional finance, but with these new crypto rails. And so, Graham, maybe just to kick it off, and thanks again for joining. Why don't you just give people a little bit on your background? I know you come from the hedge fund industry, and just kind of what sparked your interest in crypto? How did that lead to you founding one of the most prominent blockchain businesses in the UK?
hi Mitch. Yeah, thanks for having me again. It's great to be back. My background, as you said, was in hedge funds. So I spent 20 years of my career there. And then in 2013, the CTO said we should buy some Bitcoin. And I'd kind of heard of it and we put a little amount in, not enough, unfortunately. It's just one of those things where you start being involved in anything really. You start to pay a bit more attention to the news around it, the ecosystem. And in around 2017, when ICOs started to be a big thing, we kind of realized that well, two things really. Firstly, that the infrastructure wasn't really credible enough for institutions, and secondly, that this technology was powerful and it was probably going to be used for every instrument in the future. So not just the cryptocurrencies that we saw then, but for tokenized equity, debt, funds. Our belief became that everything would be on chain. So we kind of said, well, if that's the case, all financial institutions are going to want to be involved to make sure they're not disrupted, and they're going to need a credible partner, and we should build it. So 2018, we set up Archax. We went to the FCA pretty much immediately, explained what we were doing. Currently, it's not really right to say they're supportive. They had no objections. We applied. We became a broker, custodian, and exchange in 2020, the UK's first, and we got the UK's first crypto asset license as well. So really what we're building is the future of every financial instrument. We think everything, probably all of your viewers, most of your companies, the sorts of things that they interact with are all going to be on chain in the future, and we're going to put ourselves at the heart of it.
And so why, I mean, what's the big prize here? Like why should a random family office or a random hedge fund or personal investor, like why should they like, and I think what you're kind of describing is tokenization, right? When you say like bringing all financial products on chain, it's what I said up front in my keynote, right? It's representing a unit of account, just saying that you have one token, and now this token is basically going to represent a financial product. And so why should users care if you're an everyday family office? Like, why do you care about tokenization?
Yeah, I think I guess you're right. Taking a step back, what do I think of what do I think tokenization is? It's the replacement of a register of ownership of something. So for most equities or public equities, for example, their record of ownership is kept in a central securities depository in a database. For small companies, it's on a bit of paper. You know, it just, when you put a record of ownership on a blockchain, that's what I think of as tokenization. And the reason that that's important is you suddenly have an asset which is easier to transfer in a distributed way. So books and records are shared, people can check transactions. So I think you asked in your first question, what was, well, not the exact words, but kind of the aha moment. You're sitting there in a hedge fund where you have a lot of transactions, and for one transaction, I'm reconciling to the administrator, to the prime broker, to the other trader. You have differences, you're trying to fix them, but it's on a blockchain. You're all looking at the same books and records. Everybody knows what the transaction is. That's kind of the moment we realized it. But probably for your family offices and the like, you know, why is this exciting? Well, in the future, I think it increases the utility of everything they're invested in. So I'm sure, for example, you've got family offices who perhaps stay away from illiquid investments. And one of the reasons they may do so is, you know, they don't want to be stuck in a position for a number of years. But when you tokenize, you can facilitate liquidity more easily. You can enable transferability of assets. And the other key point as well is that it's not just the assets that are being tokenized here, but also cash as well. And anyone that's done anything in financial transactions will know delivery versus payment. You send cash, you get an asset. Or if you're processing corporate actions, you send cash from the asset that you have. But more often than not, the asset and the cash are on completely different technologies. When you have them on the same technology, you have them both on a blockchain, you can start using smart contracts. You can start using code that says, okay, this is a bond that pays 3.65% a year. So every day I want to drop 0.01% directly into someone's wallet. So you can automate those transactions. And when the asset changes hands, in the world of fiat, you have to have an X date and a pay date and go out and collect bank details. But you don't have to when they're on the same technology. You can see who holds the asset, let's say in their Ethereum wallet, and you know it's the same wallet that you're probably going to be paying the dividend or the yield to that wallet as well. So I kind of think of the technology, why we believe in this so much is that if you're an issuer, it's cheaper for you to create issuances on a blockchain. If you run infrastructure, everything is more streamlined. And if you're an investor, it can hugely increase the utility of the assets that you hold.
But maybe let me try to say it back to you and you tell me if I have it right. It sounds kind of like basically that we're taking software and we're taking it to financial operations, right? So all of that back-end paperwork, administrator, transfer, all of that now can execute automatically via software. So that's kind of one massive benefit. And then the other being is sort of, what possibilities can arise if now I have assets that hitherto I couldn't use as collateral for a loan. I couldn't move very quickly. And so it takes new asset classes and actually makes them more interesting. So it's sort of like two-pronged. On the one hand, it's like efficiency. It's quite boring. It's like we're going to take software and now we're going to have all that back office stuff is going to be automated. But on the other hand, it's saying, well, there might be new forms of instruments that you couldn't have done before, like using a tokenized real estate in a DeFi protocol and getting a collateralized loan against it, and then maybe buying your coffee with that and having a swap atomically into a stable coin. And now I'm going off on a tangent a bit, but do I kind of have that right? That it's almost like two-pronged. You have like just sort of boring nuts and bolts, gonna get rid of this paperwork, and then we also have new avenues, new products that could be created.
Yeah, exactly. I think a lot of people in the digital world kind of have this split between what is crypto and what are RWAs or securities. And there's a reason that Archax thinks there's both important. So if you think everything in the future is gonna be a tokenized asset and you believe in this use case, there's kind of a reason to hold cryptocurrencies because that's often the way that you pay the gas on certain networks or the transaction fees. But to your point, the other thing about crypto is, this isn't just a bunch of kids trading and creating chaos on the internet. The amount of innovation there is pretty insane. And so, I always use Aave as an example because Aave is like an online lending platform for those that don't know it. You go to a website with your assets, you send in your assets and you can borrow against them. And you can kind of repeat that if you want to create leverage, or you can just let's say you had Bitcoin for a while. No, well, that's a bad example. Let's say you had Ethereum for a while and you didn't have, and you had taxable gains. You could perhaps park your asset and borrow against it without crystallizing the gain. So what you really have there is like a lending system that's fully automated that pretty much has no intermediary involvement at all. And it's open to everyone. And then you start thinking, okay, what does that look like if instead of going there with cryptocurrencies, what about if I go there with my Tesla, with my Nvidia? What if I'm an asset manager who is running a tracking fund, and I'm long all these assets, but actually I need to somehow fund capital differences at month end. You kind of look over to DeFi and say, okay, if we can take that innovation and apply regulation to it, we can start disrupting some huge areas of traditional finance.
And one thing you just commented on is like the way institutions might think about that. And I just want to, point out that you probably have a very interesting view on this. Given that, Archax, one of the most regulated firms in the space, one of the first firms ever to get FCA approval. You didn't mention up front, but also you have a deep relationship and partnership with Aberdeen, which I think is the largest UK asset manager. They invested in the round that we invested in. And they also now you have a tokenized money market with them. Maybe what are institutions thinking now about this space? I mean, you hear it's kind of buzzwords like like you work directly with Aberdeen, you've tokenized funds for other big firms. Maybe just talk a little bit about that because you're speaking to these institutions on a daily basis. Like, are these big financial institutions, are they really interested? Like, what are they actually doing?
Yeah, I think everyone's realized, kind of back to the crypto point, really. Well, Archax started 7 years ago, and we said to everyone, we think this is coming, and people were like, well, I'm not sure. And then the kind of couple of years into our journey, people said, yeah, we can kind of see maybe it will happen. But now everyone's on board. I mean, it's taken 7 years to get to where I hope we'd be after 6 months of Archax, but that's just my optimism. But everyone's working in this space, and everyone's realized that businesses get disrupted, and you get disrupted if you don't move and do something. And the amount that's happening in the space is quite insane at the moment. So to give you an example, but just banking is probably the easiest example. People deposit in their banks, regardless of the interest rate. It seems you don't really get a decent return on your money. And all the while in crypto, what's happening is people have found creative ways to generate yield. The problem was that stable coins, which were like a huge way to make payments in the digital environment, they didn't have yields either. So what you had is these stablecoin issuers like Tether building up these, masses of reserves and keeping the interest on it. So people started to realize, okay, I can compete with Tether if we can find a way to make a yield-bearing stablecoin. And then you started to see a few pop up, like Paxos did one. It's pretty interesting, and like kind of these have started to get added. But also you've had the asset managers that have issued money market funds say, hang on a second, we're the place that people go to if they've got excess cash and want to earn some returns. And if we're not careful, then these new stablecoin guys are going to eat our lunch. So all of the asset managers are suddenly sitting there saying, well, actually, rather than a stablecoin, doesn't it make more sense to hold a tokenized money market fund? Now, obviously, tokenized money market funds have more friction because they tend to be more permissions, but people are finding creative ways of passing those through. And then separately, you've got the banks who I think felt comfortable. They were like, people will always need a bank because that's where you get your interest. But guess what? If you can get a yield-bearing stablecoin, if you've got places like Aave where you can borrow money without a risk of rejection from the bank against known collateral, then actually, why would you need a bank? So you can see the bank starting to say, okay, there's a lot of money moving into this area. I mean, RWA.xyz, security token market, they're good sources of information. I think there's over 4.6 billion that's in RWAs right now, and it's growing pretty rapidly over the last year, and I don't think it's going to be slowing down.
So yeah, and for people, yeah, basically what that is you take like for instance, Archax, Aberdeen has a traditional money market fund. So your traditional LP structure where you'd buy a share in the fund, they're gonna buy basically treasuries, Wheatbro markets, create yield. And so you can actually represent the economic ownership of that fund on a blockchain. So that way, you get it, basically you can have the experience of that financial product, but on blockchain-based rails. So it's super interesting. But maybe to push you a step further, what's next after money market funds? Because for some of us, for people on the line who don't know, tokenization, real world assets, the RWA, it's been a theme for, I mean, gosh, maybe 8 to 10 years. People have been talking about RWA. It seems like it really is happening now. Like you said, we have nearly $5 billion just in money markets alone. Um, do you think stocks and bonds, you mentioned tokenized NVIDIA, like how close is this really? How difficult is it technically? Is it something that Archax is working on and interested in? Like what do you think comes after money markets?
Yeah, so I mean, just to kind of go directly at your question, we've already tokenized AstraZeneca, Vodafone. In the past, we've tokenized carbon credits. We've just put a
And when you
million.
say those companies, you mean the equity shares of those companies?
Yeah, right. So yeah, I guess for your viewers, there's kind of two ways to tokenize, two main ways. One is that I take something that already exists, like an NVIDIA share, I put it into our custodian, and then I create a token backed by that. The other is to have a natively digital issuance where the very first time it's issued on a blockchain. For the most part, what you see in the space is people creating tokens where they hold the underlying somewhere else. There's some few exceptions, but I mean, I don't think it really makes that much difference in the short term, to be honest with you. In the long term, it probably does. But that's the sort of thing we've been looking at. We tokenized $1 million of treasuries on Hedera the other day. We're creating a product which is a 4 weekly rolling treasury product, fully tokenized, low basis points. The reason we're doing that rather than just money market funds is some of the companies that want money market funds as reserves aren't able to have them under whatever regulation, but they can usually hold treasuries. So tokenizing treasuries directly rather than funds sometimes has more of an impact. And then I guess to go back to the other part of your question, in the early days of Archax, or not just Archax, probably STOs and RWAs generally, everyone was talking about tokenizing illiquid assets. So let's tokenize real estate and fractionalize it, was probably the common one we all heard.
Yeah.
And not many
Yeah.
people then realized that the start of it would actually be tokenization of some of the most liquid products out there. And the reason has been, well, one of the reasons, well, two reasons: the high interest rates. People are seeing the rates that the stable coins are earning and being, you know what, we should gather some of that. The other thing is that they're priced at one. And if something is priced at one, it's so much easier to create automation around it. One of the challenges you have with it's a timing challenge, not an actual challenge. One of the challenges you have is that pricing a portfolio takes time, and the more complicated a portfolio is, the longer it takes. So if you've got a portfolio of treasuries, you can probably price it in a couple of hours. If you've got global equities, maybe a day. If you've got a private equity fund, then it can take days sometimes to price this thing. So if you've got something that's 24/7 transferable, it's quite hard to kind of ascribe a value to it. So I think those bits will take longer. But what's clear to me is the opportunity is the same. If you are holding an illiquid asset in the past, let's say me as an example, if I log into my Hargreaves Lansdown broker account and I've got a Fidelity fund, an Aberdeen fund, whatever it may be, it's great. It's a number on the screen, but there's not a button that says use this to do some things with. I can buy it, I can sell it, and that's kind of it. But if you've got the token and you've got functions like Aave there, where I can potentially send it in and borrow against it if I need to, or if I can instantly redeem it, then you've added utility to that instrument. So that's where digital starts to add value. You're not really getting a different product. It's still the same fund that you would have bought otherwise. But over here, you've got this kind of immobile, archaic fund on old technology. And over here, you've got a new one where the utility is bigger. So everything else being the same, you should always pick the one with greater utility.
Yeah, I mean, it's kind of interesting the way you said that things have headed. I actually, you could even start from first principles that the first thing tokenized was actually the dollar, right? If you think about it, stable coins as like you said, asset-backed tokenization, it's not a native issuance. But so we started with this most liquid, most fungible asset that you don't need to diligence, right? Everybody knows a dollar. You don't need to do any research. And so that's now a $200 billion tokenization industry. Next, easiest thing to diligence, or that you don't need to diligence, is a US Treasury, right? Which is basically what a money market is. So, right, it's like they're sort of fungible. People think they're riskless. And so you can see kind of the ladder. It's like we started at like the easiest stuff, and now it's kind of going to get harder and harder. And so yeah, maybe like as you said, like the next easiest thing might be like S&P 500, or like something that like any person doesn't need to do any extra research. Whereas if you're thinking like with real estate, every real estate deal is its own unique deal, right? It's very difficult to just buy real estate, on the internet without even looking at it. It's sort of a different thing. But so no, we're going to the end, and I might want to pull up a few questions here. But one of them that I'll pull from someone who's asked is about DeFi and what makes a successful DeFi protocol. But I think I'm going to actually amend the question a little bit. Just how do you see the interplay? Like obviously Archax is centralized, right? But you're working in a decentralized world, and then you're mentioning decentralized apps like Aave. Where do you see Archax's role in that kind of, give and pull between centralized companies like Archax that have regulations and work with institutions, and then these permissionless platforms that anybody can operate and sort of have opaque ownership and structures like that.
Yeah, I guess yeah, I mean let's say we're centralized with decentralized aspirations. Like I know in the future this will be decentralized. I didn't start from a centralized place because we didn't know it would get there. The reason we started there is because we knew it could fit into the regulations that exist, and we knew it would be understood by global regulators. Like our view is that you need to go on a journey. We're starting from something that it is centralized. However, the things that trade on our venue exist on a blockchain, and you can deposit and withdraw onto our exchange like you can with cryptocurrencies. We've also got a subsidiary called Montis that we're building. They're building a fully natively digital CSD. So like Euroclear or DTCC, we're creating one of the first natively digital CSDs. And when those two things coexist, you suddenly have the ability to create issuances on chain that trade on a secondary market. We do want to put a DEX out sooner, but there are a lot of challenges around that. There are detailed rules that exist in most credible jurisdictions about how you have to operate an exchange, and it's not necessarily, it doesn't necessarily fully work in the current DEX environments. But we're going through that exercise right now and saying, okay, how would you satisfy this rule? How would you get the regulator comfortable? How can you protect from market abuse in this scenario? So it's pretty challenging. And you're right, on the flip side, and kind of, I guess, fair play to them, there's technologists that have no regulatory background who just go straight for innovation, and it's great and it can work, and sometimes maybe you ask for forgiveness rather than permission, and they can make money and do very well. But our view is we want to work with some of the largest institutions in the world, and the way that you get there is by protecting their brand and doing things credibly. So that's kind of our approach. We want to do the cool stuff, but we just want to take our time doing it.
Well, great. Well, look, I think with that we'll wrap up this fireside chat. Just want to say thank you so much, Graham, for for everything you're doing and building and joining us. And again, one of our portfolio companies, and we're huge supporters. So thanks very much for the time today and joining us.
Thanks for having me. I really appreciate the support, guys. Good luck.
Thanks
Bye,
for
Graham.